Welcome back to the Real Estate Standard Podcast. This is episode 25, where commercial real estate and Bitcoin collide. I'm your host, Tim Kotzman. Today is June 22nd, 2026. I'm joined by my co-hosts, Kenny Alves and Chris Drizga. Each episode, we endeavor to break down how serious operators, investors, and developers stay competitive and profitable in the 21st century by examining commercial real estate through the lens of Bitcoin. On today's episode, we're joined by AJ Osborne, CEO of Cedar Creek Capital. AJ, welcome. And first, I'm going to throw it over to Kenny to give us an update on West Main storage stacking.
Thanks, Tim. As of today, June 22nd, we hold 15.23 Bitcoin, 1.5 billion Satoshis. So far in 2026, we've stacked just a little over 13 Bitcoin. That's 1.3 billion Satoshis, giving us a Bitcoin yield of just under 600%. So what does that mean? That means we've almost increased our Bitcoin holdings by 6 times than what we started back in January. Our Bitcoin per square foot is at 21,946 Satoshis. We have actually officially broke the Bitcoin square foot parity mark. And just to break that down again, there's approximately 97 billion square feet of US commercial real estate. And if you divide all the Bitcoin that there will ever be, 21 million across it, you'd get 21,649 sats per square foot. So we are now over that threshold, and we call that the Bitcoin square foot parity threshold, and we're at 21,946 sats. We've been mentioning it here every week that we have purchased over just about $1 million worth of digital credit issued by Strategy Stretch, and that is going to a bi-weekly payment starting the beginning of next month. So we'll receive about $4,600 in digital rent payments on the 1st of next month, but that's about $9,600 per month. And if we were to equate that into storage units, if we looked at our 10 by 10 storage units, that would be the equivalent of about 33 10 by 10 climate control storage units going at $289 a month. The difference is that it's 100% profit margin. There's no drag. We're operating at about a 70% profit margin. So it's about a 30% increase in income for us. And if we look at our stretch holdings, that's bringing in about 15% of last year's NOI. So 115,000 a year. That increases our NOI by roughly 15%. One last thing I'll say about the digital credit. If you look at the Bitcoin holdings, we have about 3.7 months of mortgage payments covered, and the digital credit covers an additional 3.3 months. So I'll just go over some of those. Let me get over to my dashboard here so I can walk through some of these numbers before we get Chris's feedback. Let's see here. So we got a new dot chart pinpointing all of our purchases. We've had 50 purchases since we started our DCA program. We are also keeping track of our Bitcoin yield from period to period. We have the Bitcoin gain as well, and Bitcoin per square foot. We can also now look at the increase percentage of Bitcoin per square foot over quarter, and we can see that we're continuing to grow quarter over quarter. Last week we announced that we did a tax loss harvest and sold about 70% of our Bitcoin and bought it right back. We're going to get into that next week. We're going to do a deep dive, but I'll quickly cover that here today. You can see that our high cost high cost basis Bitcoin has been sold, and we have a new average cost of Bitcoin that's going to be a lot lower, down in the 60,000 range now. We realized a $261,000 tax loss that equates to about a $96,000 in dollar for dollar at a 37% tax rate. We have all the data here to pass off to our accountants. We have the lots that which we purchased and then sold, and we're able to generate a PDF of those reports and send it out at the end of the year. And yeah, want to kick it over to Chris, get Chris's feedback on this, and again, we'll do a deep dive next week when we have the time.
Yeah, thanks, Kenny. The flywheel continues to spin, and it's only picking up. It's only accelerating, and I think it's been really exciting the last couple of weeks here to run through all of these different metrics, because I feel like we've really ramped up the different verticals over the last 6-7 weeks or so. Right, we have the dollar cost average from the free cash flow into Bitcoin. We have the digital rent vertical, and now we're starting to use some of our other tools in the tool belt, this tax loss harvest being one of them, to again optimize the overall financial performance and tax efficiency of the asset. So it's really exciting to start to see all of these different verticals come into play, and how you can tweak them here and there to optimize the situation. So those are my thoughts today. AJ, welcome.
Thank you.
Thanks for letting us run through our really long intro there, but it seems to get a little bit longer at every couple of weeks here as we build out this strategy.
Love it.
So we appreciate you making time. We have a lot to cover. I'm really excited about today's conversation because you're obviously in the self-storage space yourself. You got $400 million under management, if I'm not mistaken, and you have a couple other forks in the fire as far as technology solutions that you have implemented in your business. So I think there's just a lot of ground here to cover, and I think we're exploring kind of the same problems, the same challenges that you are, just from a different angle. And I'm excited to kind of, bat this ball back and forth here today.
Love it.
So why don't you just give the audience an introduction, high level overview of who you are, what Cedar Creek Capital is, and what you guys are focused on today.
100%. So we focus on self-storage pretty much exclusively in the terms of commercial real estate. We are an owner operator. We manage millions of square feet across 12, 13 states. We've been doing this since prior to 2008. We went through 2008. And we've really focused and led the way, clear back then. We began as a thesis of self-storage is more of a business than a real estate asset. And if you treat it like one, you can really drive yields. That's what I wrote the 2 best-selling books on our industry about. I have the largest podcast, and we head up and talk a lot about technology in the industry. We've been leaders within keyless technology, remote management, the software analytical sides, as well as AI and driving and optimizing solutions. We're probably the only private company in the world that owns and operates our entire stack, our tech stack. So it's very unique. We've been building it for 15 years. We have our own proprietary software that I call my brain, which pulls in mass amounts of data from internal proprietary data as well as external. And we utilize AI over the top of it to do analytics, optimize revenue per square foot, and more. So we are really big on the fact that technology has changed the game. It did, of course, with the internet, but that continues to rise. And that's something that I think a lot of people miss in real estate And, it's often joked, they're like, you act more like a tech company than a real estate company. And I often joke back, every company is a tech company. And if you don't realize that, you're in trouble. So that's just the nature in the world that we live in. Real estate has been fundamentally changed by technology, and it will continue to be. And we have to adapt and move with it. Those that haven't got left in a big way. And those that did have accelerated leaps and bounds.
Yeah, I can definitely co-sign that. I mean, when we were chatting last week on the prep call, I shared, my experience in the industrial real estate sector, and there was, very similar fragmentation in the sector as there is or has been historically in the self-storage space. And I think that created a number of opportunities. One, obviously, a valuation arbitrage, but two, there's a lot of latitude. There's a lot of opportunity for, forward-looking operators like yourself to come in and aggregate all of this disjointed data and, pool it together and now overlay all your systems on it and, be able to make decisions in real time, from a proprietary database, which has not existed until very, very recently. It was always a centralized system that everybody, latched onto. I feel like today, self-storage is, it's one of the darlings of the commercial real estate space these days, that and industrial. That was not always the case. So I'd maybe like to hear your thoughts on how the heck did we get to where we are today? What is the state of the self-storage sector?
Yeah, so really self-storage is fascinating because we are seeing it in its final stage. When we got into self-storage, over 90% were single owner mom and pop operators. There were a couple REITs, basically no institutions played in it. Banks didn't like it. It was viewed as a land hold or this weird side asset. That changed dramatically after 2008. Really, prior to 2008, self-storage was in its infancy. And then after 2008, it became an adolescent. And it became an adolescent due to the fact that it had survived 2008 and outperformed. That gave institutions the ability to underwrite and model the asset class. Also, technology came in and allowed third-party managers to own and operate self-storage. That allowed institutional third-party players to come in and then third-party manage. That allowed institutional capital to pour in, and that began the consolidation phase in storage. Now, from 2008 to 21, it was boom times. It was Wild West. After 2018, over 80% of all syndicators, funds, everything else like that have only been in self-storage since after 2018. Over 80%. So it was really about that time that it peaked out. Speculators jumped in. Developers were developing with expectations to flip it. There was very much a view that this asset can't fail or do. Interest rates went up, and that hit self-storage hard. It hit it hard because it was also on the back of an oversupplied phase, really due to low interest rates. And we saw rates go down as far as our rental rates, and interest rates go up. And that kind of put a pause for a few years where transactions just stopped, performance went down, and that was the end of that adolescent phase. That was the time that the air went out and people went, oh, okay, so this isn't, invincible. This isn't recession proof, which drove me nuts when people would say that. But they realized, oh, okay, we have to be serious about that. The last year, self-storage is stabilized. Occupancy, rents, people are jumping back in, transactions are going, capital is flowing back into the market, and we are now seeing the final stage, which is the mature phase of the industry, which is much like other industries. With that said, roughly 50 to 60% of the industry is still mom and pop. So there's massive consolidation roads that are in front of us, and that is going. That is picking up. The big boys have been consolidating, and that will move down. So the consolidation phase is continuing, although it looks different than it did before. So that provides tremendous opportunity. Roll up in self storage is a great opportunity. Operators can have scale. They can use technology to remote manage, third party manage. They can go in there and they can optimize these mom and pop facilities, turn them around, expand the NOI. And that has brought in a lot of innovation, that has brought in a lot of people that aren't just not in the industry, but service the industry. And that was really the cornerstone of the adolescent phase: capital, operators, and then third party servicing that would service the industry. Technology poured in. We started to do our property management. We started the largest co op and we started a property management software system, which I'm the largest owner of. I sit on the board of that company based out of Newport. And that was due to the fact that we believed that data needed to be open. People needed to own their own data. Prior to that, it was all consolidated. Now, this trend has been moving forward. That puts a lot of power in the hands of independent operators, which was the whole goal of it. Not just that we would end up like the hotel industry where, all the brands out there, 80+% of all the hotels are owned by 5 brands. We didn't want that to happen. So now we have a mix of prices that have come back down to earth. Cap rates have gone up. The industry is stabilized. It is now occupancy is stabilized. Rates are going up because supply has been killed. Over the last 4 years, supply has gone down, 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 and that's going to continue. That created that equilibrium. And now if you're looking to get in, you can get in at attractive cap rates, attractive prices. You have the tools, resources to be an owner operator that you didn't have before, right as the industry stabilizes and turns around. That gets me really excited. Over the last 6 months, we've purchased around 1 million net rentable square feet. Since third quarter, I think about last year, we're under contract on roughly 3 million more. We have not been this excited about the industry since 2010, where we expanded a lot after that point. So it is now in a new phase. It's way better than it was when it's adolescence. A lot of the flippers and people that were just looking for quick bucks that thought the industry was easy, they're gone. People are taking it seriously, approaching it seriously, but the consolidation will continue. And that's where that opportunity is. And that will keep going. It provides huge amounts of opportunity for individuals because you can buy a storage facility from $200,000 to 20, 30 million. So people can enter into the space. You can do a roll-up model. You can buy mom and pops, expand that net operating income, create a lot of wealth. It's a very exciting time to be in storage.
AJ, I want to talk about ways in which you increase the NOI, because I have a hunch that through your AI software and my brain and the tools that you're building, you're able to see many of the benefits that large REIT operators do when they consolidate and roll up facilities, because they can have their own call centers, they can have their own marketing department, and kind of eliminate a lot of those fees. Us as a more of a mom and pop operator, right? That's only managing a few facilities. We've been successful in increasing our NOI, thinking outside the box with adding solar panels, eliminating our electric expense. We're vertically integrated in a different way, in a sense where we developed and built our own facilities. So that's a way that we add sweat equity into it. And I'm just curious, is the value add that you're doing to these facilities, is it predominantly on the software side, or is there construction and expansion and other areas in which you unlock new NOI?
The answer is yes. So we do conversions, developments, expansions. We have our own architects, construction management in place. But really the cornerstone is operations. We develop to own and operate, and our ability to analyze market. Really, when we look at value add in storage, there's a few ways. First, in the operations, we look at obviously expanding NOI through growth of revenue, controlled expenses. The revenue growth that we see comes from specifically targeting the right tenants and raising that rental revenue per square foot through marketing and revenue optimization. We do dynamic pricing like airlines do. Every unit gets a different price, and we're constantly changing the prices and monitoring up that as we stabilize the facility and bring it up. And then we attract new, better tenants through our marketing. Data plays a role in all of that. The better the data, the better the tenants, the better the long-term value. They stay longer, they pay more. We only have, you got, let's say 600 units in a market that has 10,000. You don't need all the tenants. You don't need all the customers. You want the right ones. And mom and pop operators that are single operator, generally, they're not doing online leases. They're not doing marketing. They're not doing revenue management, both on the street rate or the in-place rate at all. They are operating it how it has been done since, the 70s and 80s up until really it started to change in the last 10, 15 years. So you can come in there and you can drive that revenue, and then you can, utilizing technology, things like keyless technology, you can operate it remotely and control your expenses. So it's a combination of all of those things. When we develop, we are developing as if it was a business. I'm looking at units like products. We want to find the right customers so we can optimize the rental revenue per square foot, as opposed to just saying there's demand. Let's open up storage units and we'll see which ones get there. And, during the last 4 years when demand dropped, we opened up in 2 years, the last 2 years, in the lowest part of demand and rental rates that we've seen. We brought 3 storage facilities to market. All of them filled up, year and a half stabilized occupancy in a year. 1 year and a half, we're at 94%. We've already been raising rents for over a year in that facility. The other one we stabilized in the first year, and it was over 1,000 units, 250,000 net rentable square feet. And we achieved that through the marketing and streamlining and connecting our property management software to our marketing, to our revenue management, both on the front end and the back end and the street rates. And so when you combined all of that, you're able to lift that revenue, allocate the proper resources to your expense and bottom line, especially when filling up, especially when starting, but then maintain. Labor is a huge piece and cost in storage facility. And so you can get it really out of control really, really quickly. So you need to be able to minimize that labor impact while still optimizing revenue.
I have a few follow-ups, and then I'll kick it back over to Chris. How much value do you think you're adding when you do a typical acquisition? Is it like 10, 20%, or like are these like, huge unlocks that you're finding? And there's been a few different types of storage facilities. You have the older, more traditional outdoor non-climate control that are the rows of storage units that everybody's probably familiar with. And then there's the newer facilities that I'm sure you're retrofitting that are multi-level and all climate control. So a few questions in there for you, and I'm sure Chris has got a bunch, and I'll let him kind of quiz you after.
So we do all of it. We have multi-story climate controlled. We have drive up. We have outdoor parking, all of it. And so that is market specific and dependent where demand is and where it lies. When we look at the overall value creation, our plan is we want our money back in 3 to 5 years plus profits without selling the asset through a refi. We are a long-term hold. I don't view it short-term because I can't control short-term markets. I don't know what they're going to do in the short term. We learned that from 2008. You can have the best plan in the world, but if the market doesn't agree with it, it doesn't matter. So, we look at fundamentals, long-term owning and operating, and we allow the market to go crazy and then reestablish. So our full cycle, the last full cycle we sold, I think, a year ago. That was a combination of around 10 facilities, which we don't like to sell, but the opportunity arose. It was over a 7x multiple. We refinanced out of it 2 times previously, and we sold at a 4 cap. And those weren't in major markets, anything like that. So, the determining factor is I want my money out and it redeployed without losing that asset in that 3 to 5 years. That is our method. That is our strategy. That was driven because we didn't take investors. So we built all our companies off our own backs. And I needed to invest, then had limited resources. I needed my capital out and to redeploy. So that made our acquisition target very specific at the gains that we could attribute to operations to increase that NOI, not market given. So there's 2 different kind of gains that you get. Okay, market rates go up, right? And that's what most people, okay, we'll attribute a 3-4% rental rate increase over 5-6 years, and that means it's worth X. We look at it at stabilization. I can buy it for X. Here's where rental rates are. Here's what it's doing. If we fix up, we clean up the delinquencies, we add insurance, we do all these things, we get rid of the economic disparity in economic occupancy to physical occupancy. We get it all to what the market's doing today. What is the value at that point? If the market delivers the good returns and everything like that, great. That's cherry on top, right? But at that point, I really want to be able to get my money out based upon the market today and what it's doing.
Yeah, I could drill you with some more questions. So we typically find that the refis are where the money's made, right? Like we're going through a refi now. Just found out the bank got the appraisal in, came in around 15 million. They said they're going to shoot it over after they review it, and that's where we pull out cash tax free. And historically we would put it back into more commercial real estate deals, whether it's retail shopping or self-storage. And then more recently we did a lot of solar deals for the federal tax credit. But now we have a new strategy where we sweep our cash flows and we take the refi proceeds and we either buy Bitcoin or digital credit. And we view it as another form of property. And we did the intro earlier, and I want to get your feedback on, have you looked at Bitcoin as an alternative investment for your refi proceeds? And have you looked at some of these new products built on top of Bitcoin, which Strategy and Strive are issuing, and they coined it digital credit? We're looking at that as like digital rent. We're thinking, okay, what is the risk of a tenant paying the rent every month? What is their financial credit worthiness versus a Fortune 500 company that has billions of dollars on the balance sheet? And when we look at risk reward, we see that this is got lower drag on the cash flow, right? It's return of capital, so it's got the best tax classification. And we think if we mix the two, that we can kind of transform our ordinary rental income into a more efficient digital rental income where we keep more after tax dollars. We're running analysis and we're refinancing at double the rate. We just signed a term sheet at 6.5 versus what we were locked in at for the past 10 years at 3.66. And even though we're going to double the rate and pull out double the amount, we're going to increase our after tax cash flow by roughly 30% if we put it into digital credit and go that direction, instead of looking for a new commercial property that we have to stabilize and go from there.
Yeah, we've taken an approach, and it follows our original strategy, which was, we took business income into real estate, and we allowed that to compound. I got very interested in digital real estate, as we called it, is quite a ways back. And Bitcoin, when we looked at it, we took a little different approach. We really liked the idea of tokenization as well as digital currencies as not just an ancillary, but as a hedge, especially with the allocation capabilities of it. We could get more for what we were buying. It is a different product to hedge. And when you mix the tax benefits together and the compounding effect of it, it's really good. We did, though, because of needs, we were building out our tech infrastructure. So we allocated $10 million in the last 10 years into our digital infrastructure, us alone, over 10 million, while we were allocating into real estate. And the idea at the time was that we were building the business and the tech side and the digital side while we were building the real estate assets. So we didn't do Bitcoin or anything like that because of our need to build out that other side. But we approached it very seriously and looked at it for a long time, including mining operations within the facilities that were climate controlled and we had power. We looked at a bunch of different hedges. Because of necessity and operations, we allocated into software and more recently AI, that digital product, digital real estate, because it aligned with the core competencies and it helped feed back into the original asset. But we've looked a lot at it. I do buy out digital cash flowing type real estate as a sidearm as well. I think it sounds counterintuitive, but I actually think as far as investing strategies go, they align very well.
Yeah, so that's interesting that you have been aware of Bitcoin and paying attention to it, and you've made great decisions because where you sit now with the software side of things, we talked about this offline a little bit, but you have a major advantage now by being able to pipe all that information into your AI brain, and you're like leaps and bounds ahead of most operators. I guess my question is, now that you have the software side kind of developed, you spent $10 million developing that, and you have a moat built around your business with that. Have you revisited it for the future going forward? Is there going to be any discussion on allocating future profits to Bitcoin or digital credit?
We have at this latest pullback, we've revisited. So if we were talking about this maybe last year or a year ago, probably not. But at this latest pullback, we have revisited it. Now, that will largely depend on the software and the allocation of that because we aren't finished building out our software ecosystem. Funny enough, when you look at software and the software apocalypse was driven largely due to AI replacing a division of software. There's two different sides. You have essentially, you have one side of it that is simply demonstrating utilizing data, and you're taking a platform of data, you're showing it, you're reorganizing it, and you're allowing inputs to have, it's all coded manual. AI takes out so much of that software is not needed. But there's an actual other side of software that AI creates tremendous value in, and that is wildly overlooked today. Functional software that has proprietary data. AI can't touch that. So when you have functional software in which data is proprietary, first of all, the AI has nothing, it can't get that data, it's proprietary, and the software acts as a nervous system. So instead, AI latches onto it, it doesn't replace it. And that is where our focus has been. And we believe that AI is driving those valuations. And the market right now is trying to discern and interpret which software will survive and which won't. And it's starting to land on this functional. We can utilize AI to take in proprietary data, attach it to workflows to actually execute. We can do more with it, right, than less. That's a big advantage. So it's just luck. I didn't know AI was going to come out or anything else, but our idea of having open data, aggregating all of this data for the last 10 plus years, and then putting it into the ability to execute, work within the asset, within the operations, the business side of the asset, but also attached to the asset itself through things like our Nokia and our digital side, where people can go, they can rent online, get into a unit, and their phone opens everything and does everything. That AI has just attached to it and expanded it massively. And so we have been allocating now so much towards that because of the utilization that we can have with AI. So we've really been focusing on that. But the go back to Bitcoin and our look at that, that's come up in the last 4 months, really. Prior to that, no. Now that the pullback has been here, yes, the tokenization part of it, we are very interested in an automated operations and tokenizing those operations and using blockchain to work within all of this data. That, yes, we're absolutely looking into all of it.
I think the vertical integration piece that you're talking about, AJ, with Cedar Creek, and Kenny, what you're talking about and doing with West Main is the bigger story here, right? I've seen it across the industry the last handful of years. There has been, and I think there will continue to be, major consolidation across all property types for all the reasons we're talking about here, right? Whether it's controlling and aggregating your own data, controlling costs, creating new income streams, name it. And I think the Cedar Creeks and the West Mains of the world are, they have a head start, right? And that's ultimately a competitive advantage today. And I think what we're talking about here, the last few minutes, is really hitting on what we talk about here every single week. And that is the successful and profitable and competitive real estate operators of the next, couple of decades. They're not going to be solely real estate experts. They're going to be experts in real estate. They're going to be experts in technology. They're going to be experts in Bitcoin. They're going to be experts in energy, right? And you have to not only be fluent, but you have to integrate and execute all four of those pillars at a very, very high level in order to attract capital, to outperform the market, so on and so forth. And I know we take it from the Bitcoin perspective primarily, but I love hearing what you're doing, AJ, because you're coming at the same problem, right? Just from the technology side.
Yep.
Kenny, we're not the only ones out there that are, crazy enough to think differently on some of this stuff.
Well, and you have to be in real estate. Let's just be honest. You have to be thinking about it differently and moving forward. And there's really, this isn't totally brand new. You can look at different REITs and different companies that started this. I mean, Extra Space pioneered this tech side, and they went from being nobody to the second largest REIT in the world in the matter of a decade, because the competitive advantage was so big. And so when you're going out and you need to attract capital to buy real estate, I had interviews over the last 3 weeks with 5-6 different large capital allocators. We're talking, 10 plus billion, all of them. Half of the time or more in every meeting was spent on technology. That's what they wanted to talk about. 50% plus of the time in those meetings, that's what we were talking about. They wanted numbers. They wanted to see decks. Every one of them asked, what are you doing with AI and how does AI change the landscape? If you don't have answers for these things, it is going to be harder to allocate capital. It just will be. If you look at the yields at interest rates at this level, people want to see something different. They need to see something different. You need to know how you're operating and what makes you different in this landscape. If you're operating in the exact same way that has always been, that's going to be a hit against you when you're trying to get capital, when you're looking at locations, when you're trying to get, we talk about real estate, location. And people talk about the simplicity of it. Well, that simplicity of it was simply because no one had any way of doing anything different. It was all universal data systems that we were all looking at. You couldn't even have a competitive edge, right? The only competitive you had was really at scale, capital allocation, and maybe driving down expenses through that scale, and niche opportunities that you may be able to find a lot harder to do at mass. That's not true today. And you can absolutely have a competitive advantage in real estate, and capital is getting that, and they understand it, and they want to see what your whole plan is, what your entire execution is. And if it doesn't involve something different, if you don't have something to say around it, they're going to look elsewhere.
Yeah, very well said. I mean, capital has more options today than it ever's had before. And to just kind of add insult to injury almost is, the hurdle rates and the return metrics are, increasing. They're moving away or moving farther away from the traditional real estate return profile than I think most people in the market appreciate. Right. And that's where, the technology piece comes in, right? How do I become as efficiently as I can be from the operations side, cut those expenses to the nth degree, one, and then two, where, Kenny and I spend a lot of the time is how do we reintroduce some of that asymmetric upside, right? How can we make our reserves, right, with the digital credit? How can we, implement a 3 tranche treasury strategy so that our intermediate reserves work harder, right? We have the liquidity, but we're getting, double-digit returns annualized, right? I mean, you look at, if I'm the, potential LP for any one of these deals, self-storage or any other kind of property type, apartments, what have you, and I have $500,000 hard-earned money, I got to go sink it into 1 or 2 deals, and the typical syndicator is saying, I'm going to pay you 5 to 7% a year, your capital's tied up for 3 to 5 years, and you're going to get high teens on the exit. That worked the last couple of decades, but in the world we're in today, and we're going to just continue to go further into, that dog doesn't hunt. When capital has all these other choices, and then you add in the fact that there's a completely new asset class emerging with Bitcoin and these Bitcoin adjacent products that provide a different risk return profile. They have superior features in a lot of cases, and we're not saying or advocating that real estate is a bad investment or a bad business. It's absolutely not. It's fantastic. But what we're trying to bring to the forefront of the industry, AJ, is we have a new tool, or we have multiple new tools that complement and enhance the real estate. And those that integrate those new tools into the property or the broader portfolio are going to be able to outcompete and stay relevant a lot longer and a lot easier than those that don't.
100%.
And the last thing I'll say there, and I'll get off my soapbox, is I think a lot of people, whether you're in a major MSA operating or you're in some small, country town, the real estate people think that their competition is the building next door or the sub-market that they're operating in. And that is a massive, massive blind spot, right? Like, you are now competing not only on a local level, but you are competing on a global level for capital, right? And for returns ultimately.
Barriers have gone down. You can open up your website and invest in businesses. I mean, your yield for capital just sitting there is high. You have real estate opportunities outside your local market. It is becoming more and more strategy operator specific, because with the click of a mouse, those opportunities are available. It's not the guy that you met alone at your country club anymore, because he has opportunities outside that country club network. The world has become very small, and you have to stand out, as well as you have to be aware of what's going on outside your local neighborhood. Things are moving fast. Investors are more educated than they've ever been, and they have access to more information and data than they ever had. And one of the things that it shows us too is, if you're not thinking about it, if you don't have a plan, if you're not doing something alone, what it tells the investors is you just have your head in the sand. A lot of the times they want to understand about technology, what's going on with AI, simply to see if you have any idea. That's it. Because if not, they go, you may be being disrupted and you don't even know it. There's risk there because you haven't even thought about this. And because you haven't, I don't want to give my money to you. You need to have answers to this stuff. They want to know specifically how we're
litmus test.
using AI, but they ask, what's AI doing to your industry? What is changing? How is it changing? And if you say, oh, it doesn't affect us, or it has anything, that doesn't make them feel comfortable. It makes them feel uncomfortable because they go, that's not true, right? You just can't have your head buried in the sand. And all it shows is you're not aware of the change and the risks that are in the market today. And so it actually hurts you.
Yeah, it's very much a litmus test. And I think that's a big piece that a lot of folks miss on the tokenization trend or conversation. It's not, sure, tokenization can help the operational efficiencies to some extent, absolutely. But I think the bigger story here is it helps increase the velocity of money. Right. So not only are you raising capital from your local communities, right, in maybe the Pacific Northwest and the Boise market, but you're now raising capital on a national level, on a global level, and you can distribute those returns. Maybe you go from a quarterly distribution to a monthly distribution, and where we're seeing this thing go now is it's a daily distribution, right? You're streaming payments because time is money, and there are incremental returns that people can get by getting, those distributions a couple days sooner. Right. And that's a little bit further out there than most real estate people want to go with this, but that is where this is going. And that is the primary use case that the tokenization piece is solving. There's going to be on-chain validation, as far as titles and escrows and all of that. Yeah. But that's further out, and that is not ultimately it's not the primary use case, right? What we're talking about with tokenization comes down to the velocity of money and investors having more choices than ever before. And I think for guys like you and Kenny that are in the self-storage space, there's another major macro trend that provides some really nice tailwinds for you guys, and that's the demographic piece, right? Whether it's the baby boomers or now the millennials and the Gen Zers that are more mobile than ever. Yeah. Right, you got the boomers that are downsizing, and you now have the millennials, the Gen Zers, and whatever the generation is behind them coming up, where they don't want to buy a house, they don't want to live in the same community for 30 years. They want to. They can't. Yeah, that's very true as well. So you kind of overlay, those macro components onto the self-storage asset class, massively bullish there. And now you find an operator like, yourselves that are technology friendly, forward thinking, massively bullish on the whole business model.
Yeah, the
for sure.
tokenization, the blockchain too, it opens up other things. I mean, fractional investing is become a big thing, but it will only grow. What technology allows us to do in terms of packaging up an investment and selling it fractionally to investors all over, our ability to tokenize, to use blockchain, to create an open market of illiquidable investments, making them more liquid, that is going to change a lot. You will begin to see open platforms in the future that allow you to buy and sell shares into assets that were once not liquid. We saw the first barrier get taken down with the internet and being able to not just remote manage, but allocate capital differently than a way that wasn't localized. That really opened up fractional investing. The next iteration of that is a more liquidable investment vehicle into hard assets. And there are some legal hurdles and things going, but that was the same prior to fractional investing, which changed in, 16, 17 as lawmakers changed everything else and opened up that market wide open. And then you had the technology and the ability to do it, which changed the game in funds, syndications, everything else. And this is just another iteration of that and these tools that can be used to change the way that we sell, where others can buy and sell these investments fractionally into these assets.
Yeah, I start, Chris, you mentioned about forward thinking, and AJ, you're, obviously forward thinking, kind of positioning yourself for the AI move perfectly. Just a couple weeks ago, we had some electricians come out to quote us on doing some EV chargers because we're seeing another
We
opportunity
do
with
that. Yeah, we're doing that now big time.
Okay, so with AI and robotics, like the next thing that we're thinking is like, okay, we're probably going to need to get some humanoid robots and train these things to unload moving trucks at our facility starting off. But eventually, we see a world where we have a fleet of moving trucks, whether it's a cyber truck from Tesla or another manufacturer. But we see a future where it's a hybrid approach. Like one of the things you also said, AJ, was that the barriers and the moats are falling down for a lot of operators, and you've seen the clutters of the world, the on demand storage, the full service storage companies that send a truck to your house, they load it and they take it to an offsite warehouse, and you have a whole mobile app and you can retrieve it for a fee, and they bring it back to you. Well, that used to take maybe $10 million in software engineering and development and time, right, to do that, to have that as a differentiator and to have a whole platform. But with AI and robotics, I see this at the hands and fingertips of any operator where they can build their own platform, send their own delivery vehicles with humanoid robots to unload. I think that's a little bit further away. I think the first
Well,
step is
think autonomous vehicles alone. So, one of the reasons we wanted an open platform and open data was because we looked at the push for autonomous vehicles and what happens when you have autonomous moving vehicles that are just driving around, and all of a sudden somebody could literally just patch in, have a truck go to your house, you put in your stuff and it just takes it to the facility. If you can't integrate with Uber and all of these different things, then you're just left out of a market where all of a sudden autonomous vehicles change the way completely we use real estate. Think about as autonomous vehicles get adopted, how that changes land use, parking, how that changes our ability to move around. And especially when you're talking about storage, industrial, logistics, what that means when anybody can get a moving vehicle at any time to send, pick up, get whatever you want, that changes the game. And that's not too far off in the future, right? Autonomous vehicles, the technology and everything are really here. You can go down, and I know like in Newport and everything, we're down there and you can see autonomous vehicles just driving around. And these things change real estate fundamentally. It changes the way people move, how they move, what they do. And it changes whether you are within that system and can utilize it, or if you're stuck outside that system and you do not have an integration tool. And without it, you just are SOL.
yeah, I even see.
We were talking a couple of weeks ago about, because Kenny and I've created this dashboard that we're using to track financial performance in real time. And, that was built with the help of Claude,
Yeah.
right? And we were having this conversation about how you have, everybody's got half a dozen different systems, right? So you have this disjointed, siloed, setup more often than not. And I can see in the very near future, someone build something, vibe code it, where you have your operations, you have your balance sheet, you have your mark to market pricing, dynamic pricing, all in a single dashboard. And
that's what our
again,
brain
it was
is.
vibe coded.
It takes all
That's
the
what your brain
silos
is.
out and it stacks all the silos internally. So you can do everything from rate change, street rates, in place marketing, move in, look at the financials. How does that change the landscape of it? Really, what we looked at and designed internally, this proprietary system, was everything, all these software systems that every single real estate person, every single business uses. They're individualized, they're siloed out, they're taking reports, they're aggregating them, we're looking at them all differently. And that proprietary information that your organization has is being held in separate buckets. Well, that is a massive constraint. And so our brain was opened, API'd, plugged in. So then it is all in one internal system. We can look at everything from individual renters. We can look at all the data points that associate them, how much they make, where they live. We can look at our financials. I can look at the move-ins, move-outs. We can look at the rental rate per square foot. I can see how that'll change the cap rate. I can then overlay that in our market. I can see where our high-paying tenants live, where our low-paying short tenants live. I can see all the demographics associated with it. And we can move within that system of all our data, and it's all managed. AI allows us to take all that proprietary data, make use of it that was not really available before. But most operators and businesses are still operating on a simple siloed system. They do not see the correlation. They are going through huge efforts to try to understand the correlation, to manage it, the reportings. Each department's doing something kind of different. Then you have 15 meetings to try to get every single department all on board. And so we looked at it as you have property management software, right? Asset management is done by the firm. But the firm that's doing asset management is a combination of revenue management, finance, marketing, service, construction, right? All these different things. And then you have these consolidated meetings where everybody gets in. But you don't have a property management system for that. And that's what we created.
So long AI, short Yardi, and CoStar is what I'm hearing. So I want to double click on this innovation and tech conversation just a little bit further, AJ. How much, if at all, does this play into your acquisition strategy or the markets that you're willing to entertain? And where I'm going with this is the location moniker you mentioned at the top of the hour. We have seen different states, different municipalities take different approaches to innovation, to technology, to AI. Some, more welcoming than others. We were talking on the pod here a few weeks ago. There were some cities here in Southern California that, told apartment operators that they, were outlawing their ability to use AI to do dynamic pricing, right? How enforceable and how successful that policy will be is a completely different conversation. But, we have our own opinions there. But from an operator like yourself, and you're saying, hey, we want to scale the portfolio from X units to Y units over this time period, and we're going to go enter into these markets. How much, if at all, does the tech policy, the innovation policy stance play into that decision, at the board level?
A lot. We have not entered into California nor New York for those reasons. They are extraordinarily aggressive towards implementing barriers, everything from data, from use of data, from dynamic pricing, rent management, and it creates a very unknown landscape. And all it takes is them to pass something, change something, and the business model just stops operating like it should or shuts down. So that is a big deal to us. We look at it a lot. I sit on the board. I own the second largest data company in storage, which just looks at markets, analyzes, right, all of that. And that data of location, where people are moving, how are they moving, what the supply is, who's building what, everything, right? That is so fundamental important. But just as important as that individual micro location is how the state is approaching operations, laws associated with building, rent control, everything else. And there are locations that we just feel are so unknown right now. And it's not even that they're unknown. New York just got in a lawsuit with Extra Space. California came out about rent management and rent controls. Now, in multifamily, that's one thing. In storage, though, that is so fundamental and key for us to even be able to own, operate, and manage. It's not like multifamily, right? Like this acts more almost like a retail. We have people coming in every single day, in and out. We have people moving in and out. Our prices change all the time. Think of it more akin to almost like a hotel, right? We're just constantly rate increases, lowering rents, getting people in, getting people up, opening up inventory, letting people out. A 5x5 climate controlled is not the same as a 10x30 drive up. One's a contractor that uses it. Other one's someone that lives in an apartment that is trying to store wine storage. Totally different customer base, totally different operations. So those laws would impede on the business model so much it could be devastating. So we are very concerned about that. And even the threat of it makes us stay away.
I appreciate you sharing that because we talk about the jurisdictional arbitrage on a fairly regular basis here, and I think that's another issue that a lot of people are sleeping on.
It goes the same
California
for
has been a
Bitcoin
fantastic
too.
real estate market for 30 years. It goes the same for Bitcoin. And if I was spinning up a new fund today and developing a strategy, that jurisdictional piece would be a key pillar because of it, right? What is your technology stance? What is your Bitcoin stance?
Yeah.
What is your energy policy?
Yes.
Right. So you kind of come back full circle to the four pillars that we talk about on the show, right? You're going to be an expert in real estate, Bitcoin, technology, and energy. Right. And how you integrate and operate those four pillars on any given asset, it's going to change, but you have to be able to, be fluent and execute at a very high level.
Absolutely.
That's where it's going. And you may not want to hear it, but it's the truth.
Absolutely. And I think people can really get into a trap when laws are passed that have second, third order consequences that you have not thought through, that are associated with your revenue, how it's generated, the taxes, right, associated to everything from solar to energy to, this stuff has big effects on that return profile.
Yeah, I think there was
agreed.
just a state that did something last week where they were going to charge a 0.2% fee on any Bitcoin transactions, whether it was, moving to your
Yeah.
own self-custody wallets off exchange or anything. And so, imagine being, located there and just being a Bitcoiner or having a business that does Bitcoin transactions. That's detrimental. That's, unplugging you, from the life machine there. And after listening to you guys cook on this stuff, I'm thinking like, wow, like Arizona, like we all know that they have very favorable self-driving laws, and to kind of tie it back into how we were talking about essentially autonomous storage units on wheels is like the end game, right? And you don't need the actual truck with the robots. It's just a storage unit and the robot walks out of the storage unit. But it seems like states like Arizona that are most pro AI, pro self-driving, pro energy are going to have these smart storage facilities of the future. And if you're located in these states that aren't proactive in the discussion of energy, Bitcoin, and these type of things, you're going to suffer from it, and it could really hinder your business.
Well, and the problem too is the laws. They say things like Bitcoin, but then in the laws, they write and the wordage isn't even necessarily about Bitcoin. All of a sudden, it's about digital transactions. It's about And I think that's what most people miss. The intention may be X, but what it actually affects and stops within the application of that law has a lot more effects that nobody's ever thought through or thought of, because these things are not that simple and they aren't isolated. They may say Bitcoin, but then all of a sudden we're talking about blockchain. Now all of a sudden we're talking about ledgering, payment processing. We're talking about, all of this other stuff. And that is just not, it's not only not being thought of, the politicians, people writing the laws, they don't even understand it. They have no
Hmm.
concept whatsoever of it. So there's so much risk, even when the intention may not be that, within your business model in those places.
We
Yeah, very, very, very well said. Sorry, go ahead, Kenny.
we had Dan Hershey from Rhode Island Bitcoin Policy Institute, who's been advocating for favorable Bitcoin legislation and regulation, and as well as AI. And so now I look, and I'm looking at these states. Do they have a task force? Because they're voting to have a task force to look into these things. And the states that don't put together a task force and have knowledgeable people on there working to uncover this stuff, that is a huge risk, I would think. So I would think that we see more state task forces put in place, just like we had the federal government put in, a crypto czar. I think David Sachs has since stepped down. He did the maximum contribution he could do as a civilian, 100 days or whatever it is, 100 business days. But I think that I'm surprised after this discussion, we haven't seen more states enact their own crypto czar or AI czar to the state level to create policy and make sure things are going okay.
Yeah. Yeah, I agree. And they're trying to get ahead of something that they don't understand. And one of the reasons is we don't even understand how it's being applied. It is all in flux. The application of so much of this technology, the technology is coming out, the application is rolling out later. You can just decimate growth and opportunities from it, because you're trying to get ahead of something that isn't materialized fully, and you're stopping it from materializing fully. That is very dangerous to do in an open market. And the states that don't do that will see expansion and growth. The amount of capital today in the economy that is allocated towards technology, AI, is outstanding. The percentage of our GDP and the growth of the markets are very much centered around this. And states that are that are open, they will see abnormal growth in comparison to the others. We looked at job openings, for example, over the last thing, and you have any state that was open with AI, taking AI investment, manufacturing, everything else, their job openings were skyrocketing, and their things, and the ones that weren't, it was negative. And so this amount of concentrated capital, thesis, and allocation will create a tale of two worlds. So for me, it's not only about the application of our business model, it is the fundamentals of the real estate, the demographics, people moving, salary, income, and the economy in which I'm building and owning and operating my real estate. If they are going against those things, capital's leaving, and it will continue to. People will leave and they will move. And we've seen today in the United States, growth is not even. You have states that are exploding and other ones that are shrinking. And it is largely driven by this. These laws that will be enacted and put in will have consequences economically for years to come. The ones that don't are open. You will have capital allocation. You're going to have business startups. You're going to have population growth. And that will have massive effects, obviously, on your real estate value and for years to come. This isn't a light switch. If you even hint at it, capital's like, I'm not going there. and then it's done for years, right? Capital goes elsewhere. Infrastructure is built in. People move there. And we're seeing that today in real times. You want to get an idea of what the United States will look like in 20 years, look at the growth rate, capital allocation, and investment dollars into the different states. And you'll have a very good idea in 20 years where people are living, what they're doing, economies that are growing, employment, personal income, just by looking at the last 2, 3 years and which states have really opened up, have really taken on and allowed and allotted for. It is not even comparable. It's actually shocking the differences.
I want to tie something together because we've been talking about AI and we haven't really got into the data center component, and
Yeah.
the rules and legislation have been impacting where data centers can go. And I know when we spoke offline, one of the value adds that you were considering, I'm not sure if you've done any yet, but you were thinking of using a portion of your storage facilities maybe as data centers. I think you said like
Yes.
10 to 15,000 square
Yeah.
foot data
Micro data
centers.
centers. Mhm. Yep,
Yeah, I think
we
this
were
is
looking at
maybe a
that, and data center right now is just such a hot button politically, everything else. The misconceptions are wild. You just hear about the craziest stuff online associated with data centers for people that have no idea what they're talking about. It's actually crazy, but the political pressure for it is real. And that comes from these mega data centers. Well, the data center allocation and build was huge, right? Over the past 3 years. The political pressure that has come down, people fighting these things, that is actually going to have long tail effects on demand. And when there's an expense when you're building out a data center, once you get past a certain size, the need for energy, power, infrastructure within that data that you have to spend on a per square foot basis skyrockets. If you're under a certain amount, it can be maintained to be more similar to traditional. And we have viewed that, our architects and construction, we've looked at buildings. That's roughly 15, 20,000 square feet. Past that point, it changes very much how the building has to be built, what you have to install, both on the power and the cooling side, and the cost skyrocket. So we've looked at our ability to take buildings that are already constructed. We already have the security features, keyless technology, entrance, exits. We can be monitored, tracked, and we have the climate controlled portions in them to take out segmented parts of them and develop them into data centers. And we're looking at that on 3 or 4 of our different sites. And I think that conversion data centers, or more of these micro data centers, as I call them, will become of more and more demand, especially in a local area where people need local businesses and everything. They need data centers. I'm not talking about Micron, right? Or I'm not talking about Microsoft. I'm not talking about these mega trillion-dollar companies that need 4 million to 20 million net rentable square feet in one building, right? I'm talking about local businesses. That demand is going to increase a lot. And we firmly believe that. We're seeing that. But just over the last 6, 8 months, the pressure to politicians and the local pressure on building data centers has skyrocketed. The amount of misinformation out there on it, the amount of craziness out there, that pressure is real. And I think that is going to limit data center construction in the United States a lot.
The other thing that would open up is I'm not sure if you're running your AI models, if you're running them locally, like on your own hardware,
We have our own
or
servers.
yeah, so this also lets you expand, right? Like you can
Exactly.
expand
Yeah.
your own local models
Mhm.
there, and I'm imagining this is going to be like a co-location similar to that, where You have the key cards and the security, and you come in and you can
That's
go to
correct.
your own rack, and you can, whether you got your Mac Minis or you got the more traditional kind of computers, you can mess with your stack in there. And to your point, every local business is going to need their own local model to handle their data, because a lot of operators are not going to want to use something in the cloud like Claude or Grok because of their proprietary data. They're not going to
Yeah.
want to give up their secrets, and they're going to want to protect that, especially if it's
Or they
like,
need a localized backup. So if the cloud goes down or something happens, that they actually have it, that they can operate it. That's a big deal.
yeah, so it's just so interesting how all these kind of, the four kind of areas where it's commercial real estate, energy, whether it's solar or any other renewables. I know guys that do geothermal as well in colder states. And bundling all these together under one roof, where you have the solar panels up top, you got the data
Yes.
centers down below, and the Bitcoin and cold storage. It just seems like inevitable for that to be the real estate standard of the future.
Well, and the yield will dictate it. The per square foot yield on server racks compared to anything, compared to living, compared to storage, it's not comparable. It's so much higher. So the yield for someone that's doing it and applying this, I mean, even just EV charging stations and the solar panels to offset the power consumption by EV solar racks or your server racks and everything else, you put that together, you get the tax benefits, the tax credits, the write offs from the real estate, the solar, and you can charge per square footage on the server racks that is three, four times or more what you could get for traditional space. And then you also, on top of that, you have your EVs out front at your discounted power that you're giving that's getting charged back and leased back to you. It changes the yield massively on that real estate, and that is going to be things that investors are going to look at because the numbers will speak for themselves.
So I want to dive into that a little bit, because what we're describing is ancillary income streams. You got
That's
the
correct.
income from all those different operations that you talked about,
Yeah.
and we installed our first solar array about 10, 13 years ago. And at the time when we went to go do a refinance and we had some income being spit off, the banks wouldn't treat that income as seasoned income, or they wouldn't give us any credit for it. They're like, "Yeah, that's nice that you have that, but we're going to underwrite this based on your storage income." Fast forward to today, like we're getting deals underwritten where they take the solar income to account, but where they're not taking into account is our Bitcoin holdings and our digital credit revenue. And so what dictates whether it's NOI or not? Because what does NOI stand for? Net
Yes.
operational income. And if one of these things has an impact on the other, it's counterintuitive to kick one to the trash and care for one and not the other, because they have invisible trade-offs, like you mentioned, the tax implications, right? If you're unable to offset some of that after tax revenue, it makes you a weaker operator. So I'm interested in like, if you have, with your underwriters and lenders, if they give you trouble on any of your um ancillary income streams.
Yeah, they absolutely can. You see the most problems in the development process. So if you're doing development and then you're putting forth some of these ancillary income streams in your pro forma and everything, that's where I think you get a lot of the pushback. If you have it or you've installed and you put it in and you can show a track record, then it's really the NOI is the NOI. Like it's seasoned, you can take it out. They may discount it depending, but I think that's getting a lot less as long as it can be shown. And as long as you can have a record and a trailing 12, right, of that income coming in, depending on how consistent it is, right? The more inconsistent it is, the more they will discount most likely those cash flows. But when that you're looking at the bank on the market, you're taking an NOI, and if it's over a 3-year and the NOI is growing and it's still that, the NOI is that NOI. And so you're not going to get a lot of pushback on that part. So I'd say in development for financing, you can get pushback. Refinances or sales, as long as you have trailing 12 of what I view as more consistent type, you start to get very little pushback.
That's something Chris said early on, that, we just need more like historical data, right? Like
That's correct.
we've adopted our Bitcoin treasury almost a year ago, come July, and then our digital credit strategy just at the beginning of this year, and we got to kind of prove it out. Like, hey, once you have 12 months, like you said, sometimes it's even longer, like 3 years, 36
Yeah.
months. So we're hopefully setting the stage for our lenders and outside investors today for the future.
The
And
one thing that they will look at too, though, is the weighted average. So if the weighted average is, of that income is a certain weight that is above and beyond, you started getting over 20% of what I would call core income, that can change things, because then they look at it as that it's no longer that core income. It almost becomes like a different asset class,
right.
right? And so outside that, yeah,
And I think that's why Chris, we've been paying attention to the total asset breakdown, right? With the different assets. Right now, like, we have about 5% allocated to Bitcoin. It's another 5% to digital credit. Our solar is about 7%. So a majority of the income is coming in from the real estate, and like you said, it's like a minor um, contributor, but it really impacts the overall operations. And as you're scaling a portfolio, you can scale the Bitcoin, the digital credit, the data center revenue, the solar revenue
yeah,
with the overall real estate portfolio. So
yeah,
once it gets up to that 20% threshold that you talked about, that's when hey, maybe we should look at adding another property to the mix, or acquiring another piece of real estate, so we can kind of keep those percentages in line.
yeah. And as long as it's foundational to the real estate, even if it is ancillary, you're usually going to be okay.
Well, we've been chatting for almost an hour and a half now. I don't know if there's some more topics, another can of worms we want to open up, or if we want to maybe close it up for today and have some closing thoughts.
Is there anything we didn't cover, AJ, that you want to share or dive into?
I think, when you look at all of this, what's taking place, the opportunity is the fact there's just way more areas that you can niche down. There's way more strategies that you can implement to set yourself apart. Starting out, that's really important. If you have the same exact model that somebody that has $1 billion in assets has, then what is your advantage? Why are people allocating capital? What are you doing that's differently, right? This is great for people, especially I think starting out. It allows themselves to set themselves apart, to bring something different, to separate from the herd. And that is the best way to start. You niche and you expand from there. All of this that we're talking about, I think, is just an opportunity for those that are looking, that want to break into it, that want to get into real estate, but they view it's capital intensive, or they don't know what, they don't know how. There's so many opportunities right now. It's exciting. It's fun, right? It's like there's a lot of different ways you can go about it. And it just takes some research. It just takes really looking at what's working, what's not, finding those opportunities, niching down into them, and then moving out from there. And I love it. I think it's exciting. I think the world is, real estate is real estate. It's not going anywhere. It's not, AI is not getting rid of real estate. That's not happening, but it can enhance it, and it can change the way it's utilized. And those things are all opportunities that can be used. And a lot of people, especially people that have been doing real estate for decades, they're not changing what they're doing. And that is an opportunity. They're so used to their edge is size. Their edge in the market is doing the same thing at scale, having those relations, not looking any other way, and just repeating it mass. And that's something that can be taken advantage of.
Yeah, I think what you're describing here is that there's more than one David now to take down the Goliaths. That it's thousands of Davids coming for the big Goliath, and it is exciting. I think I wake up every day excited just to be able to try to bridge the digital real estate with physical real estate, because as a second gen real estate developer, it's much tougher to develop, right? It's much tougher to build from scratch. The real estate is the original scarce asset, right? And
Yes.
this allows you to develop in a new way, whether it's on the digital frontier with AI and Bitcoin, and then tie it back to the physical real estate. So well said, AJ. Thank you so much for coming on. This has been one of my favorite conversations thus far, and hopefully we can check in with you again in a few months.
Absolutely. I appreciate you guys having me on. This is a blast.
Thanks so much, AJ.
I'll echo the sentiment from Chris and Kenny. AJ, appreciate you joining. That's it for this week's episode. If this conversation was useful, please share it with somebody, a partner, a client, somebody making decisions in the market. New episodes of The Hurdle Rate drop weekly. Until next time, stay disciplined, think long-term, and stack sats. This is the Real Estate Standard. If you enjoyed today's conversation and you own commercial real estate, we'd encourage you to think about how these broader shifts might impact your own property over the next decade. Many owners are starting to reconsider how they structure their balance sheets, manage capital, and position their assets for the future. If you'd like to explore how some of these ideas might apply to your own situation, you're welcome to reach out. We work with property owners and investors to think through strategy, structure, and long-term positioning in a rapidly changing market.